Hi, investors. It's Nick.
Hi from Martin.
And today we are effectively responding to a very interesting WhatsApp thread from one of our clients, which is, I got money, interest rates have gone up. What do I do? Do I just sit and wait, or do I get in the market? And another part B of that is I've had too many failed offers, so not getting a high enough acceptance rate. And so I just want to go through this with Martin. So the first thing is I want to talk about interest rate rises, what that kind of means. I've done lots of videos and stuff about the history. I'll talk about that in minor details. So interest rates, then talk about first principles in buy to let, because I think it's very important to always have a basis from which you derive your reasoning, and then which areas work for this. So Martin and I have done this a while, and we're very kind of tuned in together because we both believe the same stuff, because we see our assumptions tested constantly, and therefore we have quite a refined idea of what we think works best, and we want to share that with you. So anyway, the interest rate rises. I'm going to share my screen with you briefly, and I've done a couple of things. So um, I've adjusted our WhatsApp calculator. So the minimum break-even gross rentable yield is about 5.3%. And that means the cost of the property, the asking price of the property, plus the renovation, and then you divide that by the annual rent that's expected. So it has to be 5.3, 5.4. And I think if you want to be fairly safe, you go to 5.5, 5.6. Now, obviously, most people are buying in a limited company entity, and therefore you can offset the cost of interest against profit, which reduces the negative impact of the deal, of the interest rate rises somewhat. But overall, the upshot is that as interest rates rise, one has to go for more yield within reason. And also, it's very important to bear in mind that higher yielding properties also go up in value. But I don't want to get into like a really long thing about the property cycle and where we're at and all of that, because I talk about this constantly. And if you read my article, How Much Higher Will Property Prices Go, you'll understand. I go into it in a lot of detail. But the short of it is that I always say that we're in a period similar to the 1940s, with raging inflation and relatively low interest rates. So, in other words, Bank of England back in the mid 1940s during the war, there was huge inflation, supply side inflation from the war, and the the Bank of England raised interest rates marginally to try and combat that. So that sounds very familiar to today, and so it should be. And then once inflation subsided, then interest rates dropped back down again. And then you had various bouts of inflation. And really, interest rates ended up being flat from, say, 1929 or 1930, we'll call it, through to 1952, 53, 52. So we're talking 20 plus years, basically. And it's not dissimilar to now. So we had the crash in 2008, and we're 14, 15 years in now. And I absolutely expect interest rates to keep relatively low. And there's a very simple reason, which I explain constantly in this and other videos. It's to do with UK public debt. When you have very high UK public debt, then the government doesn't want to raise interest rates too much, because it will nuke itself. It'll make its cost of borrowing really expensive, and then it would have to raise taxes, and then it would go into a negative cycle, and they would lose the next election. So they're not going to do that. And the reason they did that in the 70s was because there was very little public debt and also very little private debt. And therefore, they could afford to raise interest rates and to combat inflation. But inflation was kind of triggered for very different reasons in the 70s. All right, so that's the story there. And so what I absolutely expect is just relatively low interest rates relative to average base. So historic average is about 4.5% base rate. Most of the economists who I follow, the ones that are sensible, that is, seem to believe that it'll be 3%, 3.5% base rate interest rates, and then that'll be it. Even in a world of, say, Gatehouse charging 6.5%, 7%, a deal can work if you're getting something over, say, 6% gross yield. And then the question is, well, if I'm not making any cash out of it, where am I making money? And again, I've done a big video on this, but the short of it is that you make money. Previously, you made money through capital gain, so low interest rates, high capital gain, and this time round, it's lowish interest rates and inflation. So inflation erodes the value of debt, and I've done a big video on this, which you should have a look at. I'll put it in the description. Maybe have a watch of that. It goes into it in some depth. But the short of it is that if you factor in the eroding, if you think of your debt as stuff that you want to erode over time, then if you're paying, say, 5% interest for round numbers, but inflation is 10%, then in true purchasing power terms, your debt has gone down by 5%. So if it's £100,000 mortgage, £5,000, which is what, £500 a month, more or less, £450 a month, is just wiped because of inflation. Now, the trouble with all this stuff is it gets quite conceptual and quite out there. But in short, all I can tell you is that I am very comfortable with this regime, and I think it works financially. And in 5 years of fixed interest rates and high debt, or high inflation eroding the value of debt, then the debt that I would own would be eroded by maybe 25, 30% because of cumulative inflation. So in other words, the purchasing power of the debt that I own. So I have a mortgage of 100,000, and we fast forward 5 years, and inflation has been constantly high at, say, 5%, 6%, we'll call it, then that debt is now worth 30% less in purchasing power terms. So I could buy £100,000 of something today, and in 5 years' time, I need 130. That £100,000 is worth £70,000. Anyway, I don't want to go bore everyone with it, but the point is, it's fundamentally important here, and it affects your game plan. And with all that in mind, let's talk about the next thing, which is, all right, so we have so the next thing, I guess, is you go in, you pay the high interest rates. How long do you fix for? And my feeling is that interest rates will probably subside in a couple of years. That, I don't want to say it's my hope, but I think what I would do is I would buy on the basis that the yield is high enough to sustain 3% base rate interest rates. I would fix for 2 years, and then if inflation, well, trouble is inflation is going to be chronic and it's going to be sustained. And that's because of massive supply side issues, not only lack of cheap energy, but also the fact that we're transitioning to green, to a carbon-free future. And also in this country, we've got Brexit, which is a huge overhang, and that slows down our economic growth. But in those kind of circumstances, banks have a tendency to drop interest rates to try and stimulate the economy and, in effect, print their way out of trouble. And since people who own property tend to be the voters. They have the power to drive that agenda, and they want to see their properties go up in value, even if it's nominally. Uh, but anyway, right, I digress a little bit. So, okay, so I don't know the answer. I'm not certain about it, but I think if I could get a 5-year fixed at a decent rate, then I could just forget about the problem and I'd be done, which is exactly what I've done, by the way. So I got my 5-year fixed sorted out 2 months ago. 3 months ago, before the two interest rate, because I knew this was coming, because I study my macroeconomics and I can see how the cycles are working, and I knew it. And I think interest rates are going to rise again, and then they'll plateau out and maybe subside in a couple of years. I'm not 100% sure, but I know that you should make the deal work at, say, upper 5%, so 5.5% upwards.
Yeah.
So with that in mind, the next question is, well, okay, so what are the first principles with buy to let? And I would say, or we would say collectively, because Martin and I are very synchronized on this, that you you start with who the tenants are and how economically solid they are. So the best tenants in the world, in my opinion, the best tenants are not young urban professionals, because their life is in flux. And when you have people coming and going, you have void periods, and then you have costs for getting new tenants in. And so you may think they're great tenants, but that's not really the case. Arguably, double income, 1 or 2 children, is a good model. So this is a couple. They're both working, they're raising a family, they've got plenty of disposable income, but not enough to buy a house. They want to be somewhere within the environs of, say, a big city, and they are, let's say, variously between them, they probably earn about £50,000 a year, or 50 to £60,000. So they're not like lawyers or dentists, whatever. They're a couple of tiers below that. In socio-demographic speak, they are social grade C1 and C2, those kind of people. And for those people, it's a 3-bedroom semi-detached house in a area that has some public transport access, and it's well suited to a car, and it's got supermarkets and all of that, and nice schools and nice amenities and so on. And it's probably within 30 minutes public transport of central Manchester, if we talk about Manchester.
Or 40. Yeah.
Yeah. And there are other big cities that are kind of interest, but Manchester is unique in that it's really drawing very economically capable people into that city, much more so than Liverpool or Birmingham or whatever. And it's one of the most socially coherent cities in the country. It's like London is a great mixing pot, but it's unaffordable. Manchester is also very mixed, but it doesn't have huge social division, because there's just enough of a mix of different people for everyone to integrate. Whereas, say, Bradford, Birmingham, parts of Oldham and Leicester and cities like that are just very culturally separated from the rest of the country, and therefore it's difficult to see how they're going to do really well in the future. They do have a lot of capital gain, but when you look at the fundamentals, which is the economic side of things, the gross domestic product and so on, it in general, it's just all a bit shaky. So this is why we end up going back to Manchester. Doncaster is another really nice town. It's a smaller conurbation, but it just works on loads of levels because it's a major distribution center. Demographics are good, property stock is nice, and so on. So that's all of
Yield is
that.
good as well.
Hmm?
Yield is good. It has good transport. It's far away from London, and for example, it needs like 1 hour and 40 minutes to arrive to London from Doncaster. And for example, from Sheffield, you need 2 hours and 10 minutes. Just like have 30 minutes faster transport, which is great. And the distance, aerial distance is similar. So that's why like Doncaster really works, especially for buy to let, because I think it will have a huge potential to be extended city to be larger, and a lot of like small towns around the city that will all be connected better than what's now. But yeah, I think it really works as a city. And also I want to add that other cities also works, but sometimes like Sheffield is really good city as well, but the yield is hard to find property, which especially now with the interest rates increasing, it will be hard to find a property who will work in the yield, because in Sheffield usually the yield, uh, especially because the prices are around 200 in cities around city center in Sheffield, and the yields will be like five. The rent will be like 850, 775, depends, and on 200 plus the renovation, it's not really work. So that's why we don't usually suggest Sheffield right now. Yeah. So
Well, and just on the yield thing, and then maybe Martin, you could share your screen and we'll go through areas that you think are interesting. Just on the point about yield, the question is, why is Sheffield got a lower yield? Now, obviously on the face of it, because they're not paying so much rent. Well, why aren't they paying so much rent? Well, the answer is that there isn't enough industry. There isn't enough economic activity to draw in people who aren't necessarily going to buy, but need somewhere to live because they're drawn by the work and the jobs and so on. And Sheffield's just that prime example. It's a university city, obviously. But beyond that, it's just not very economically strong. Same with Liverpool as it happens. And the other thing to say is that every city has its own particular characteristics. Liverpool, for example, has huge swathes of very intense, very dense private rented accommodation. In other words, areas with huge proportions of private rented. And arguably, there's almost a glut of private rented in Liverpool because historically it's been quite a poor city and people haven't had the money to buy their own properties, and therefore they've had to rent, which is kind of the wrong dynamic. What one's after is a dynamic city where people are drawn into the city to work and they don't have the money to buy, but they need to live somewhere, so they rent. And that's how that works. Crew has a similar thing going on, but the difference is that the level of the level of worker is slightly lower in Crew than it is, say, in Doncaster, and therefore you get slightly less good tenants, slightly less good quality property, and it just slightly doesn't work as nicely as Doncaster does. So it's whenever you think about property, all roads go back to one thing, which is who is the tenant, and then you kind of deduct your logic from there. So would you be able to share a screen and show us some
yeah,
areas which kind of work based on these principles?
yeah. So for Manchester, so basically, we know, for example, that SK5, it's reddish. It's really famous and it's really hot. And the capital growth is really great, as you can see here by the numbers. That's so basically it really works, but the problem with that is that the asking price, for example, it will be 220, it will go up to 250, the winning offer. So it's really competitive, but they have nice demographics, nice capital growth, low crime, good transport to Manchester, really close, like less than some locations have like 15 minutes to Manchester, some have like 30, depends where, in which part of Reddish. And but on the yield, with bidding so much, and after you will have issues with validation, because it will have down validation for sure, because we will bid a lot than the market is right now.
Actually,
So
you touch on an interesting point. As interest rates go up, so will the bank's risk appetite go down.
yeah,
So what the way they do it is the simple way they deal with risk is they just say, we don't think this property is worth that much money. It's
yeah,
much easier for them to do that than to judge the risk of the buyer, if that makes sense. Just go, the property's too expensive. And thus we have a much bigger threat of down valuations these days than we've had for years.
yeah. So that's also like, so this is the location where it's really nice. but I will avoid. And maybe you will have more chance to if you're buying like in a stock quote if you go with cash, because the yield really doesn't work and the price is too high on the properties. So for example, also Dresden is similar, but it's not that hot. It's still
I
hot.
can I just draw back to the SK whatever it is Stockport
Yeah,
stuff.
yeah,
So what happens there is your classic herd mentality issue. So people who don't look at the high level stuff and don't necessarily think along first principles and don't understand capital gain, etc., what they do is they don't understand where they are in the cycle, and therefore they just do. And what they do is they look at their friends who bought and they go, well, you made a load of money. Your property's worth a lot more today than it was 2 years ago, whatever. I want some of that. And then you get fear and greed kicking in, and then you get a speculative bubble. One of the most classic, notorious speculative bubbles was probably in Liverpool and arguably in most city centre housing with the lifestyle apartments, which are not, they kind of work for renting because young people like to live there. But the catch of those young people is they move around a lot and you're constantly trying to find new tenants. It's just messy. But anyway, the hallmark of a speculative market is where the idea of prices being so great, the place will always go up. It must be good because look at all these other people who are piling in. That's your classic speculative market. And whenever I look at capital gain, I'm much more interested in gain driven not by investors, but by homeowners who love the place.
yeah,
So I'm always wary of investor driven markets, which is Swinton, Stockport, Salford.
yeah. Echoes as well. This particular
Okay, yeah.
because it's also really like and we noticed that their like properties are really going much above the asking price, and the property stock is good but not the best. For example, I would prefer Dresden. For example, it's really nice, larger houses and really close also to Manchester. And I even like for the same price, which is same direction from Manchester and so on, but here is driven by investors who really bid a lot. And in Dresden, like if the property is 220, you will take it for 240 maximum. And in Stockport, you need to go 30, 40K more than the asking. We have one situation in Swinton where the asking price was 185, it's go for 240. Like,
Yeah, so
what?
I just want to talk about that for a second as well. So two things. One is interest rates. Last time I checked were, sorry, not interest rate, exchange rates, Hong Kong dollar to GBP was was quite strong. So if you compare it to say, I think 5 months ago or something like that, the you basically you're 8 to 10% up in terms of purchasing power. So that means that £200,000 property 5 months ago, whatever it was, is now the equivalent of £180,000 to you because your currency is stronger. So I can't remember the exact numbers, but the idea is that it has a big effect. The second thing is inflation. That if you're sitting on a pile of cash, then and you're suffering high inflation, so it depends which country you're in, but if it's the UK, it's 10% roughly, then that means that £200,000 is worth £180,000 in purchasing power equivalent in a year's time. So you're hemorrhaging money in nominally or not, but the value of your money keeps going down because the government keep printing more of it and the inflation is high. So so therefore there's a real drive to get your money out of cash and into something which will hedge against inflation. And property is one of those things that people dive into. And when I look at the equation on this overall, it is really good. The ROI is amazing. The cash ROI, not so good. But when you factor in all the other variables like inflation and like capital gain, broadly, the ROI turns out to be somewhere in the region of 15%, something like that, if you factor all these other variables in. But if you want to take a narrow view and say cash ROI, well, then there's no point. You may as well just let your money burn erode due to inflation. But as I said, a lot of buyers are paying with cash because they just need to sink money into something that's an inflation hedge. Anyway, back to you, Martin.
Yeah. So I want to say like this place feels worth is not driven by investors. I mean the price is not that high and it's really close to Manchester. So this is interesting location where you can find like you have terraces house, you also have semi-detached house. So even some detached house. So you can find really nice property with around 5 to 6% yield after renovation, after bidding, and you don't need to bid like 30 30K more than the asking price. So also some part of Mooston it really works, especially here near the park. So you have a lot of like nice places where you don't have that competition. For example, also Middleton is interesting place, but the prices are low. I mean, compared to we have good transport to Manchester, but the price is around 150. Let's say two bedrooms, semi-detached, or 160, and the yield will be like 6.5%, 6%. So and because of that, a lot of people bid high just because they have space in the yield. So basically, if the asking price 160 and the yield is 6.3, they can bid up to 190 and the yield will still be 5.5. So that's why I have a lot of competition, a lot of investors buying here. So for example, I think like most on third world, like also Droysden, if you want to higher price properties, better to buy here than buying in Salford or Swinton, just because you have a lot of competition and the houses are really same distance and demographics are really similar and the crime is similar. So but here you will buy 70 meter square property and here you will buy 90 meter square property with bigger garden. So that's why I think like uh, it's not just good to go in the places where, especially now with high interest rate, so the yield will not work in this kind of places because you need to bid high and plus down validation. So everything together is the deal will not really works. So
Yeah, and just adding to this, so when we look at cities, when we look at other cities like Liverpool or Newcastle or whatever, and we do constantly look, it's just very difficult for these areas to really make sense, as it were, in terms of just value, demographics, and quality of housing stock, and so on. And so we always end up gravitating back here to Manchester. Just on other areas, Martin,
yeah,
Oldham, south of Oldham, we talked about that
yeah.
a few times.
Yeah, yeah,
That's quite interesting.
yes, and also like Usher Under Lane, some location in Usher Under Lane are good. Just like, for example, Oldham, Middleton, here, Usher Under Lane, you have a lot of risk of coal mining. So if the property, sometimes the property will be great, but it will have like coal mining issue. So I will not post it because it's a risk. So then
Mm.
um, you cannot buy the mortgage because it will not be approved because of the risk of coal mining. It will be less than 20 meter, under 20 meter away from the coal mining entrance. So
So,
basically, we're trying to avoid this kind of place. I mean, houses. So it really works. But for example, from 10 properties, only 5 will not have a risk. So from those 5 properties, when we calculate yield and renovation and so on, and the location risk, so then only like 1 2 property in a day I can post. So you can see like this is the properties what we think that they are good in the last 4 days on the market. So you can see, for example, this property here in Middleton also works, but it's really close to the highway, so it will be a noisy. So when you check the location, you can see
mm,
it's really close to the highway. It will be noisy, so we will avoid this kind of property. It will work. The yield will work. It will not have risk of coal mining or flooding, but the noise will not work, and then it just we avoid the property.
well, this touches on a really important topic, which is it's easy to buy bad property.
Yeah,
Everyone wants to sell you a donkey property. And we see this time and time again with clients who show us properties that they've either bought through other sources, and I'd say 70% of properties that they bought through other sources are just we wouldn't touch. But sometimes people get nice properties, it's a fact.
Yeah,
But the fact is that it's just very easy to buy a bad property. Everyone wants to sell you that one, but the good ones they're competed for. And then we're into the whole thing about what is the optimal property. How can you outcompete and get a good offer to offer acceptance ratio? And this was one of the issues that one of the clients brought up, that just like they were feeling disheartened because not enough accepted offers, but a very strong buyer. And we have other clients, so you may want to stop screen share for now.
yeah. I just wanted to add, for example, this place here, Brimington, is part of Stockport. But when you zoom in, you see, and I know that some people like to buy here, but you can see this is like isolate place, and the demographics are really like bad, and the crime is just to show. You can see the numbers, everything what
Oh
is
yeah,
above 50, it works, 55. But here it's like the score is really low, like demographics are terrible, not really terrible, but bad. And I will never buy here, but it's in Stockport, so some people will just sell you this kind of location, just use it. Oh, you buy a cheap property in Stockport, but it's not really worth. And just say like every area, like Stockport, generally it have great area, it have okay area, it have bad area. So you just need to know and to avoid the bad area, not buying.
yeah.
Yeah. So I just wanted to add that.
So on the whole theme of uh, what is a good property to buy, and how do you get your offer acceptance rate up? Well, I have a couple of views on this. I don't know what you think, Martin. I'm curious to see. My opinion is you pick properties. Well, firstly, there's a bit of luck because you never quite know what the sentiment is for the owner, for the occupier, for the vendor. You don't really know whether they are have sentiment, what I call sentiment bias. What does that mean? Well, they might prefer owner occupiers. They might prefer English people. Whatever the bias is, people are biased, and it's just one of those things. So about 40% of the time, I would say, if hypothetically we had the highest offer, 40% of the time we wouldn't be offered the property because of sentiment bias, just to say. Then the other big problem is people are are optimistic. Buyers are optimistic. You, as a collective, people who work with us, you're optimistic, and you kind of need to be, really, I suppose. But the problem is, it's very easy to look at a property that needs no renovation whatsoever, has a beautiful backyard, has nice features and amenities, nice garden shed, whatever it is that makes it nice. But the catch with that is that so do owner occupiers love that property. And then you're competing against them. And then it's a question of how much do you want to spend? And generally speaking, what I find is that we there's a threshold which I called uncomfortably high. So it's still kind of sensible, but the numbers are creeping up a little bit and the yield is thinning out. And for those kind of properties, you just have to bid. It's not viable, basically. It's not worth bidding £240,000 on a £200,000 house, because you'll have a mortgage value down valuation. And the other thing, of course, is for foreign national buyers, UK sellers are concerned about foreign national mortgages and down valuations on the mortgages. So even if you're bidding right up there, the perceived risk is that the mortgage won't come through and it'll just be a mess. Then really the only viable option is to offer in cash, but then you lock up an enormous amount of money. And if you're dealing with Gatehouse, you don't have the completion is expected to be done relatively quickly. And if you're trying to get a Gatehouse mortgage underway and get drawdown of funds from a bank, you don't have time, because Gatehouse take ages, to like 3 months to process a mortgage application, versus HSBC or Hampshire Trust or any of these other lenders, typically a month. So you run out of time. So therefore, we're down to really very few properties that work. Really, you know, if you look at the number of properties that Martin has filtered. Martin, could you do me a favor?
Yeah.
Could you just share a screen? I just want to highlight a point that you may not appreciate. Can you just disable the time filter on the map you were showing us and just do last 14 days, for example? So no contenders, just a raw or even 3-day filter, whatever, but just no filters, just all the properties we see. So the thing that people forget is that there are very few properties that really work. And like properties in beautiful condition, they work for some people who are prepared to make hugely high offers, but less so than it used to be because the growth curve is easing off and surveyors are starting to get more conservative about valuations now. So then you're into right, there you go. So this is how many, this is a lot of properties. So this
Yeah,
is how many days?
for 13 days basically,
Right.
including weekends. So that's mean like 10
And is this
working days.
every property we're seeing, or is it just houses, or what?
Yeah, every like this is also only like flats as well.
Mm.
But this is only up to 270.
Right.
Okay.
So then you've got everything else, haven't you?
Yeah.
So that's my
So
point, that we see thousands of properties
I will
week
just
in,
zoom
week out.
stop. Yeah, yeah. So I
Yeah.
can zoom in just here in Stockport, and I will just close the other filters just to not to have only the properties. Okay. So basically, you can see all the house icon represent a property.
Now
So
these
basically,
just, they're not
this is
flagged or anything, they're just properties, or are they
yeah,
properties of interest?
yeah. This is just one example. This one here, 250. So it's a leasehold. It needs some renovation. Maybe I posted, I don't remember because I've seen a lot of properties. So you can see that needs some work on the roof, nothing major.
See, this is a nice property in that it needs more work than an owner-occupier is necessarily interested in tackling.
Yeah,
Although saying that, it is in good condition internally.
yeah, and it's good. I think I posted. I'm not 100% sure. And we can see that the floor plan is okay. So yeah, for example,
So,
this is a proper. So
so
for example,
the point being, so Martin, maybe if I describe the perfect property to purchase, then maybe you dig out a couple of examples, that would really be good. So
okay,
it seems to me, on balance, the very perfect, the best properties are over £140,000 in good fundamental conditions. So they've had a big makeover in their lives at some point. The plaster board is, you know, it's got good ceilings, good floors, good walls, no damp, good electrics, probably a modern boiler, but it looks tatty. It looks like it needs a lot of work, but we know that the essentials have been looked after. So that would be the perfect profile, and it needs more than say £10,000 in renovation. Owner occupiers would rather put that £10,000 cash into a bigger deposit than spend the money renovating a property, and therefore you have less competition, and therefore you're more likely to buy the property. So it's a few things. It's all the usual stuff which you're seeing on the map. It's condition. It's a buyer who's willing, who's not in a hurry, or sorry, a seller who's not in a particular hurry to complete, just an average completion, which means they're not going to get frustrated if it's a gatehouse mortgage. It's got no major compromises as such. It's a central location, but the big one I think is condition, and probably avoiding old terraced houses as well. I generally find them risky condition wise. They're okay,
yeah, but
but
depends. We had one really good house, but we bid for it, but it doesn't. It was
mm,
old terrace house, but good renovated, good maintenance. You can see by
yeah,
the walls and so. But
generally as well, older people are more sentiment biased than younger people. And the other thing is that whenever the vendor does the viewings, that's usually a problem because when the vendor shows people around the house, what they're doing is they're checking them out and they're saying, oh, do I like Mary? Do I like whoever? And the problem we've got is that, well, it's one of our representatives. So they turn up and say, hi, I'm from blah, blah, blah. And immediately it gets 3 negative points. It's an investor. It's not the person I want to sell to because I don't know who these people are. And then you get the whole foreign national thing. So generally speaking, if a property is being sold by purple bricks, we just avoid because they're notoriously difficult to deal with, and we've never had a successful outcome with them. If it's Yopa, Strike, or any of the other kind of self-service agents, I'm always a bit apprehensive. And generally, the best success rates come from the traditional agents because the agents themselves understand exactly what they're dealing with. They know that you're good for the money and they see your offer and they see your documents and they go, okay, well, this is a legitimate buyer. And they're not biased by sentiment and therefore they advise the client accordingly. And our hit rate with those kind of agents is actually reasonably good, relatively speaking. Certainly good enough for us to have a viable business, let's say. So, so these are the kind of variables that I look at all the time. And at this stage, I have a fairly good feel as to whether a deal works or not, like
Yeah.
just straight off the bat. And I
Oh,
suppose one
okay.
other thing is tenanted properties is really interesting. There's a lot of
Yeah.
risk there, but if you can deal with the risk, then it puts off all that competition from owner occupiers, and that's a very good thing.
Yeah.
So
So
here's a good example, isn't it? Yeah.
yeah, it needs some renovation, but not fully. Like, but I can see the walls looks good, the ceiling's good. So
Yeah,
not
this
the
is a
best.
prime example.
Yeah,
It
it needs
looks
like 10,
awful. Yeah.
yeah, it needs like 10K, maybe 15 to renovate. But it's generally, I think, should be fine.
Well, you can
It's
see it's good because you can
yeah,
see the walls are flat. It's got
yeah,
plasterboard in it. The walls
yeah.
are good. The ceiling's good. The
The
bricks are
yeah,
good.
the electricity is high enough.
Yeah, it's just that's a really good example of a really choice kind of property
Yeah,
where
and
the
a lot of,
fundamentals are good. We saw a property the other day, or I saw one which I
but
flagged up for a client.
this
And
one is an issue because it's from hills. And
yeah,
Hills doesn't want to work with for national and third parties. So
mm,
just an example, like how a good property we will not have chance even to view, not to have a
mm.
chance to buy it.
Hills are, yeah, they're difficult people to deal with. But that's just an example, condition-wise, of a property that's optimal.
Yeah,
And the fundamentals of that house are really good. And
yeah,
most owner occupiers don't have a clue about condition. They just see a messed up floor and they go, oh, it's probably terrible. They have no idea, mostly. Like very few people understand property. And therefore that's where you have a competitive edge. So kind of taking it from the top. It's areas like, what are the areas? Radcliffe?
yeah.
List a few areas, would you?
Yeah, Radcliffe, Middleton, Fylesworth, Droysden, Asher on the Line, also were like Little Houghton, so Walden. This is like a place.
Doncaster, obviously.
Yeah, no, but I mean, talking about the area in Manchester. Yeah,
Yeah.
Doncaster is good. In Doncaster, you have like location which are not the best, like Bentley, just because the prices are low, the yield is great, but it's had flood risk, so
Mm.
which is not covered by insurance, so that's avoiding. So yeah, there is a lot of like also like Mansfield, like a place. It's a nice to invest just because it's not that small city. It's small, but
Yeah.
still good.
Well,
And it's the prices are not too high, and the yield is still okay. It has good transport, so yeah, just like
yeah,
some
well,
place.
actually, you touched on another interesting point that the other reason we tend to hang around Manchester is because people have confidence in Manchester. But Martin is constantly testing other areas and putting properties out there to see who's interested and wants to hold their hand up for a viewing. We did some work around Mansfield, which was quite good. There are places like Blackpool, which kind of interest me. Generally speaking, any smaller urban conurbation more than 2 hours drive from Manchester, from London, should I say, going north. So the south doesn't really work at all. It just generally doesn't work. So everything above Nottingham starts to get interesting. And as Martin pointed out, there are lots of these small conurbations where our ability to assess that area is as good as any other area in England, basically. So we can assess with equal knowledge because what we assess is based on the data. So the data is constant through everywhere. And that's why, for me personally, I I've been trying to release some money for a while, selling some property in London. It's just incredibly slow going. But once that finally happens, I'm going to be looking at a mixture of Manchester and smaller urban conurbations. So that could be places like Bedford, um, uh, Leamington Spa, just kind of working my way up north. But these are small towns, 50,000 people, that kind of size. Big enough Doncaster, which I really like. They work really well. But the thing is, we're only going to present them to you if you're interested. And generally, as a collective, you're not interested. So we don't share those properties with you because we don't want to, we want to give you what you want as much as anything. And we want to give you what's safe for you as well, because
Yeah,
part of the deal is that we protect you from hurting yourself financially. So, which is a unique business model for property sourcers. But there you go. Like our model is, we want to place a property with you. It doesn't matter which one, as long as it's the right one for you, and we'll get there in the end. Anything else you want to say about properties of like the perfect property, the one where we have the greatest chance of buying?
I think we know that the hit rate in famous location like Stockport, Swinton, Eccles, Salford, it will be like even we send that high offer, it will be the hit rate will be really, really
Mm.
low. Just because we're going with mortgage, we we're buying from foreign national, and usually a lot of owner occupiers want to live in this kind of place, and so it's really it have just have a lot of competition just because we avoid if a property some maybe and have some compromise like I don't know the condition or the flood risk or the coal mining or location like without not enough parking or not private parking or depends on the price or crime or so we will avoid. So we just trying to identify the perfect property and the perfect property, the people who live there, who understand the properties, they bid a lot and they just want to buy it. So that's why we don't have a lot of chances to purchase a property who is like really really good. So
Mm. So
and
the
really,
up yeah, exactly. So the upshot is, if you want to improve your hit rate, find properties that need work.
yeah.
We pick out we this, and also finally, because we need to wrap up, I guess, but just finally, can you just explain the logic behind sending so many properties out to people, Martin? What's your rationale for that?
What do you mean so
Well,
many?
that we'll send 10 properties a day and it'll be a mixed bag of different properties and some in good condition, some not, etc. Why not just send out only properties which need renovation?
Usually I'm taking because some properties we also buy not I usually don't sell properties in perfect condition just because it will have a lot of competition with owner occupiers and I know that those properties will go like 20 or 30K more than the asking price just because the owner occupiers don't need to pay extra money to renovate and they can bid high. Usually, I'm sending property who need at least 2 3 thousand, like need some works. But on photos, you cannot identify correctly. Usually, when I said 3,000, when we view it, I think that usually it's go 2K or 3K more, just because the real estate agent don't show real situation of the property. It always have some like a crack, not crack, but some like plasterboard. It will not be the best shape, or they need new boiler, or maybe the flooring need replacing, or the carpets, and on the photos looks good. So I'm trying to send properties which will work, will not have risk, will not have any risk, I mean coal mining or flooding or location risk. It will not have like bad demographic, it will not have a lot of crime. The capital growth will be positive. English speaking will be okay, it will be English area, the transport will be good, um, markets and shops will be around, schools will be, you will have a green space also. So basically, when you everything together, like all everything what you can think about property, all the metrics and the figures combined works, and the yield works, and the capital growth works. So basically, that's why I think this property is good for investment, just because the property needs to work about the numbers. You don't need to live in it. You don't need to love the property. Just the location and the tenants need to like the property and to be easy to rent out. So basically, when all this together, so I'm not just sorting properties who like need 5K only to renovate or 20K. I'm giving all the properties, I mean, after renovation, after bidding, the yield to be more than 5.4, 5.5, so the property will work in long term.
Well, on that note, let's finish it there. Thank you very much for watching.
Thank you.